So I'm going to do the pound now, the euro pound. A lot of people are interested in the euro pound. I did do a big video on this, but this is a good time to update it. So let's go ahead. The euro pound at the moment, let's start on the monthly chart. You can see you've come up for 2 months already prior to this month. That is your third month there. The euro pound is really, really choppy, and it has been for a long time. I think a lot of people have noticed that. They're very closely correlated. We're not far from France or Ireland, so we're right by the eurozone. Not that it particularly matters in this instance, but it's really important to know the choppiness of the market, because trading choppy markets is actually very easy, and I'll tell you why. So, and this is also in line with risk plans. You've got to have risk plans to do this. Don't try it at home if you don't. So if I just label all these areas, I've said it so many times before, all these areas of market value for shorts, that will start to help, I should think, for a lot of people. When I say market value for shorts, I'm referring to the fact, if you look at this price clearly, okay, and it's not up for it's not a debatable topic. What I like about trading via probability long term is the fact that you can't deny everything I've labeled is a high price not preferred by traders to the long side. How do I know that? Well, I know that because if I just open my eyes, there's a candle wick there, there's a candle wick there, there's a candle wick here, there's several candle wicks there. I'm not going to label every single one, but there's a lot of them. And if you're sitting thinking, you know what, I'm lost. Why is he highlighting candle wicks? Okay, I know what candle wick is. I know what it looks like. What's the point? The reason why I'm doing that is because I'm trying to get you to understand that people up this point who were buyers have obviously killed their trades. Okay? And I know that because when you get a candle wick, people exit and the market comes down. Okay? Because when you exit long, you're effectively short. And people again find that very hard to grasp. But it's so simple. The fact is that if you're a buyer taking your entry out of the market, you are now a seller. Okay, inherently you're a seller, because if if you're exiting it long, then you think the market's going to drop, right? So that is what causes the candle wicks. So I can solve part of the puzzle already by understanding that I know where people who are long are likely to do this. They're likely to pull it off because that is a preferred price for long traders, buyers alike, to exit their positions. Okay? And that's what makes the probability here. So having known that, I can say to myself, well, if the market comes up here, I would be far better off as being one of these people than I would if I decided to buy at this point. And again, it's factual. That is a factual statement because historically, if you look, however many times it was, if you imagine a football match, it's 10-0. It's 10-0 to the sellers. So why would you not short again? Okay, why would you decide to buy up here? People do it all the time. Believe it or not, people always message me and say, "Why isn't it a long? Why wouldn't I buy at these highs? The market is coming up. Why don't I buy?" And it's nonsensical. It makes absolutely zero sense factually, because that is a short area. Buyers are exiting, you get your candle wick, they pull their orders out, and the market falls. And the story, of course, is the same to the south side. So had you traded like this for the last 8 years, you would have made money every single year. And again, that's factual. As long as your risk plans were right and you didn't have enormous sizes, if you traded lightly at the absolute extremes, you would have made money all these times. So that area you had is just a pullback into early support, and you're now coming back up. So if you come up to this point, then I would look to reshort once you get there. It doesn't mean you need to be desperately early. It is a short now. Technically, it is a short now, but you've got much better market value, trading in line with where the smart traders will be getting out. Okay. If you're someone who's looking long, okay, and you'd like to buy pound, the euro against the Great British pound, you'd probably prefer this 200 MA to creep along a bit, like it probably will, and you want to get back in line with that and that and that, because for the same reason buyers are exiting at the top, you then get the flip side, okay? And it's slightly different, okay? You get the exact opposite of what you've seen already. So sellers exit and buyers enter. So, like I said, you've got the opposite of what you've seen at the top because the opposite action is occurring. That is why your long bias comes at lows and your short bias comes at highs. It's simply because that is how markets work. And they always have done so. And like I said, what my favorite thing about trading is the fact that, I'm just looking for a good place to put this, is the fact that if you do it factually and you do it based on what is real and what you can see at the time, you get far better results. Um, that's basically how I trade. It's all based on factual evidence. I mean, people who lose money trading, they always do the same thing. What they do is they buy high and they sell low. That has never worked. For thousands of years, since people have been roaming the earth, okay, even if you're a caveman, you would want to get the most meat for your meat or some wood or whatever it is. You always want the most for what you're selling, okay? You always want to get the most for the least when you're buying. That is how people work. Um, and like I said, that's fact. Find me someone who likes buying high. Everything they go, oh, that's expensive. I'll just take that. Oh, that costs 3 times more. I think I'll get it now. You know, it just doesn't make sense, but people will buy into resistance, buy into price rejection, price action areas that are clearly areas for sellers. So I hope now you know what side of the market you would rather be on. Certainly for myself, I want to short up here. I want to buy down here. And it really is as simple as that. If you mix in concrete trading plans and you trade risk averse with concrete risk plans, that's why I have a massive video series. That's why I spend so much time mentoring people privately. You know, then things will start to be a lot better. So if you want to get that, don't forget it's underneath this video. That's my free training. Don't forget to like, share, comment, subscribe, follow me wherever you're watching.